Welcome back to Primary Source China Investment. Peng Guo and I are here with show Y3. And the topic this week is nowhere to hide. As global investors are getting hit on all sides in all asset classes, we thought it'd be a good time to stop and pause and see what's happening on the ground in China. We're actually recording this show as the 20th National Congress of China's Communist Party is underway. And I'm sure you'll all read about it in the press. You don't need Peng Guo and I to cover that for you. So let's get back to assets. Globally, asset values are down. Nobody is immune. But for Chinese investors, the decline in property hits the hardest, as real estate is, and its attendant economic impact makes up perhaps a third of GDP and 70% of Chinese individual worth in real estate. Peng Guo, you and I have covered real estate before. Maybe you can just give a quick comment on how important the real estate sector is to Chinese individuals, investors, and the economy.
Yeah, China real estate actually is the major asset for the most of the family. Initially, some of people get rich by the multiple real estate. But right now, all the market get cooled down, and also in fact, the local government's income. So there's many reasons affect that. I think a primary reason is the ordinary people's income cannot support such kind of the real estate price. So this way doesn't it's clearly unsustainable. Another thing is the China government is their local income is rely on sell the land. So all those model is cannot be sustainable is from the beginning. So I think it is really like the design back to the starting point. This model is not sustainable. Obviously, in the past 30 years, real estate is the core business in China. It's a consumer a lot of the industry products and also drive other industry get grow up. I think right now it's people understand the question, but the problem is they cannot have an effective way to solve this problem.
This really affects sentiment as well. If the merry-go-round of increasing prices and increasing wealth stops, then sentiment is going to take a real hit because, you know, for like you said, for the last 30 years, this has been a great investment. You just buy real estate, it goes up, and you get wealthy. And if that investment thesis is over, then the sentiment is going to change dramatically.
Exactly. Yeah. That's simple. Yeah.
So just a few headlines, right? Property investment dropped 13.8% year on year in August after slumping 12.3% in July. It shed 7.4% in the January to August period. That's investment. New construction starts measured by floor area plunged 45.7% year on year, its biggest fall in almost a decade. New home prices are falling at the fastest rate in 7 years. So it's not only you and I reading this, it's people experiencing this on the ground.
Yeah, I think right now the most of the challenge is really try to control the risk, not expand to the financial or bank area, and of course the bank get crushed. Yeah, I know like some of like a local bank is already almost bankrupt. Major bank, I think right now is still be fine, and it looks like they find ways to survive it. At least the worst time period is already gone.
Well, we did remember earlier in the year we were hearing about defaults from real estate developers, large and small. So, you know, what clears that? It's a market clearing phenomenon. If prices drop, then people are going to step into the market. So you need to have a price reset before really anything. And if you don't get that price reset, you're just going to have a lot of vacant property.
That's exactly right. Yeah.
So we'll look to see if there's actually a big price reset. So,
yeah, but the stock market is already understand this kind of change. I realize like the real estate related sectors already bounced back. And also, some of the stock is get an investor's radar. So you will see the market talk about the real estate sectors and a bunch of the companies, which one is good. That really means people start to have interest in those sectors.
Right. But remember, every time it's different. So people may be early also. You may see another leg here. I don't know.
That's a big cycle.
I'm not predicting anything, but I would be very cautious about jumping into that. But let's talk about stocks. So stocks have taken a significant hit this year. You know, renminbi depreciation contributed to more pain for dollar investors. Just give a quick example. The CSI 300, the major market index in China, is down 22%. But for US investors via ASHR, it's down almost 31%. And for those of you thinking about KWEB, those biggest China tech names, a lot of them have migrated now to Hong Kong. That's down more. That's down 37.85% year to date. Only energy, as we talked about in the past, is up year to date. So the stock market has really taken it on the chin. This is no surprise for anybody that's been following along. The question now is it becoming more value? Price earnings ratio has really dropped. It's come in a lot. Expectations for earnings are high, but if we're listening to the 20th Party Congress, zero COVID is here to stay. There's going to be no change to that. People are talking about the GDP growth for the country was going to be around 5.5%. That looks optimistic by probably a factor of 2, which would lead China's GDP growth to the lowest level since 1976. So a little bit of caution remains. I would say a lot of caution remains at this point.
Yeah, it's really related to entire global equity market. But I think a major thing is you need to compare China performance with other market. Initially, we saw the China market is down. That's pretty bad. But when you compare others, it still looks good. And also, it looks like get started to bounce back. Overall, China should have a much strong foundation to resist the recession and many more risks compared with other stock market performance.
Well, I would focus also on those, big state-sponsored, some would say sleepy/boring companies, because those are the ones that are going to benefit. I mean, if we're listening to what's coming out of Beijing, those are the kind of companies that are really in favor, and those are the biggest will get bigger, I suspect.
There's always, in any market, big company always get special advantage.
Also maybe some flight to safety. So before we go, I wanted to touch on the fixed income market, because here's where you see a huge divergence between US dollar investor and renminbi investor. So, you take a garden variety 5-year treasury bond fund on the mainland, and if you're a mainland investor in renminbi, you're up about 2.3%. We all know for U.S. investors looking at fixed income, there's very limited optionality. So the one that we keep looking at is CBON, and you took a 12% loss year to date on that, and all of that is renminbi depreciation, which is off 13.5% to the dollar.
Strong US dollar is definitely the same in the market. Yeah. So I realize this same affect all the asset class. That's probably put the investor nowhere to hide.
Yeah,
that's exactly right.
That's our theme. I mean, look at Japanese yen, look at pound.
That's exactly right. And on the gold and whatever equity market, everything get down. So it looks like. But always just think about it. So the dollar have the cycle, but this time it's just too quick. So I think probably it will give some opportunities. Think about the dollar. Take this dollar cycle to get an extra benefit for that.
Well, we're going to leave it there with show Y3. Thanks for tuning in. We'll see you next week, and make sure you read all those notes from the 20th Party Congress. We'll talk to you soon.
Thank you.